Hello everyone, welcome to Brilliant Bankers. In today's session, we'll be discussing about the risk and the basic risk management framework. The previous video of the forex trade, we have discussed about the different type of risks in international trade. That is a credit risk, country risk, currency or the exchange risk, political risk, and different type of risk. All were discussed earlier. So here we are going to discuss about what is a risk and what are the basic risk management framework. So where do we have the risk? In most cases, we observe that there is a deviation in what we achieve from what we have planned or what we have expected. The unpredictability of the future is due to the uncertainties associated with the steps that we take in the process or the various external factors that influence the processes that are necessary to achieve a planned objective. So there is a uncertainty all in all the things that we are doing. So any kind of uncertainty is risk. Risk refers to the potential for an event or circumstances to result in a loss, harm, or an undesirable outcome. It involves uncertainty about the future, where therein is a chance that something may not go as planned. In various constructs, risk can refer to different type of potential negative outcomes involving the financial loss, the physical harm, damage to the reputation, or other adverse consequences. So, finally, risk can be defined as an uncertain event with financial consequences resulting in loss or the reduced earnings. It can also be defined as uncertainty resulting in adverse outcome in adverse in relation to planned objective or expectation. So this is what we discussed earlier. Financial risk are uncertainties resulting in adverse variation of profitability or outright losses. So where did this word risk come from or where was it derived from? It was derived from the word risicare, which means to dare, that is to take on the challenge. Risicare means to dare, which we can say it as to challenge. So in some cases, going into an example, let's take the example of a simple trading business. Consider yourself as a stock trader and you have invested on a script for you have taken a script, a single script for rupees 25. In this case, and on the next day, you find the script at rupees 20. What happens? There is uncertainty about the cash flow and the price of the script in the stock market. So there is also an uncertainty in the profit also. Like in the case of a simple trading business, there could be variation in sales and the unit price realization would create uncertainties in the cash flow. Uncertainties in purchase price and cost price also can create uncertainties in the cash outflows. So what is the difference between a uncertainty and a risk? Uncertainty is imprecise knowledge about the future events. On the other hand, risk is that kind of uncertainty which can be systematically assessed through reasonable, reliable probability, distribution of the outcomes, and therefore measured and priced. It is such kind of an uncertainty which can be systematically assessed through reasonably reliable probabilities on the distribution of the outcomes and therefore measured and priced. So uncertainty is a clouded situation And from uncertainty, one has to travel to the risk situation from where only he can start managing his risk. So, what are the uncertainties? These uncertainties associated with risk elements impact the net cash flow of any business or investment. Under the impact of uncertainties, variations in net cash flow takes place. This could be favorable as well as unfavorable. The possible unfavorable impact is the risk of the business. Whenever there is a lower risk, there will be a lower variability in the net cash flow with lower upside and downside potential. There will not be a lot of variation in this kind of risk. When the risk is low, the variation will be low and you have a less risk. Higher risk could imply higher upside and downside potential. For example, let's consider the case of a retired person who is investing some fund. Okay, for example, rupees 1 lakh at 6.5% interest in a RBI bond that matures in 5 years. This gentleman would receive an interest of rupees 3,250 every half year and would receive a payback the principal after the maturity period is over. Here, the cash flow associated with the said investment, as we all know, does not have any uncertainty associated with it. In other words, this is a risk free or a zero risk investment for the period it is invested. It may also be noted that this investment being risk free, returns are also lower as compared to the other investment opportunities available in the market. So, what is a zero risk? Zero risk would imply no variation in the net cash flow. You have a continuous cash flow of the same amount. Return on zero investment would be low as compared to other opportunities available in the market. So, in the case of lower risk, there is a lower variability of any growth. In upper risk, you have a higher variability of growth, and in zero risk, it implies to no variation in any growth. Now, in the case of a risk, there is a main connectivity between the risk, capital, and return. Let's discuss that in detail. Risk, capital, and return are called trinities of risk management. So, in this case, what is risk? This is a measure of uncertainty or the possibility that things might not go as planned. In investments, it means that there's a chance you might not get back as much money as you put in, or even you may have to lose some. What is capital? This is the money that you invest. It's like your starting fund. The more capital you have, the more you have the potential to make more. But it also means you have more risk. So, what is a return? This is what you hope to gain from your investment. That is your profit. You take risk, you invest your money, and you take your profit. That is risk, capital, and return. That's why this is called as a trinity of risk management. So, how are they linked? As we discussed earlier, more risk, the more potential return. As we said, generally, if you are willing to take on more risk, you might have a chance to make more money. However, it also means you might lose more if things don't go well. More capital, more potential return. If you have more money to invest, you have the potential to make more money. But if you also mean the same thing, if it goes south, balancing return and risk. How can you balance the risk and return? It's important to find a balance that you are comfortable with. If you are very risk averse, you might go for a safer, lower return investment. If you are willing to take on more risk, you might aim for investments with higher potential returns. You can also diversify your investments. This is a strategy where you spread your investments across different types to reduce the overall risk. It's like not putting all your eggs in one basket. Remember, every investment involves a trade off between the risk, capital, and the potential return. It is important to understand your own risk tolerance and the financial goals between all the investments before making any investment decisions in any condition. And especially, this is not an investment class. Here we are discussing about the risk, capital, and return, the link between the risk, capital, and return. So, as we discussed, the risk, capital, return are the trinities of the risk management. Let's take a case. If in a business, or if in a Mr. A has gone for two types of investment. There is investment one and investment two. In both these investments, the yield uh, is 30,000 at the end of the 5 years. In one investment one, you get a continuous income of 6,000 per year. A continuous income of 6,000 per year, making it a total of 30,000. And investment two, you have a fluctuation. That is, initially it is 3,000, then it is 9,000, then it is 5,000. Then you have a minus 2,000 and then again 15,000. A total of both is 30,000 each. After an simple initial investment of rupees 50,000. From the return on investment point of view, both the investments are equal. But intuitively, without going into the arithmetic, one is more likely to prefer the investment one. This is because of the steady stream of cash flow associated. Investment two would have a chance to become equally acceptable provided if there is a higher interest rate in it. This 2% additional risk is a risk premium or the cost of fight. Higher the risk, the higher should be the premium. Since the amount stays the same, we will be opting for the equal cash flow. If there was an increase, if this was to be 35%, then automatically we would have opted for the second investment plan because the risk was higher and you have a higher yield also. In other words, risk is a business or investment and is netted against the return from it. This is called the risk adjusted return on investment. That is the RAROC, risk adjusted return on investment. The risk adjusted return happens to be the key factor for decisions of the investors. The RAROC plays an important role by measuring performance against the amount of risk undertaken by the branches or the departments of the business units. RAROC is a better performance measure when compared to measures like the return on assets, that's the ROA, and the return on equity, the ROE, and are not satisfactory for evaluating the performance of business lines since they ignore the vital factor, the risk taken by the banks. So, in the case of the banks, RAROC is the main or the vital factor for considering the risk because ROA and ROE doesn't consider the fact of the risk. The higher the RAROC, the higher is the reward to investors or shareholders, and more preferable is such kind of investment would be in the market. The capital requirement of a business or a revenue model would depend upon the risk associated with the business or the revenue model adopted by the business. And the expected return on the investment would also factor in the risk associated with it. The higher the risk in a business model, the higher would be the capital requirement and the returns expectation. The reverse is also true. So therefore, RAROC, that is the risk adjusted return on investment, is an improvement over the traditional approach in that it allows one to compare two type of businesses with different risk profiles. So why is the risk, or can you manage this risk? If so, why is the risk to be managed? We know that the uncertainties associated with the risk elements impact the net cash flow of any business or investment. Under the impact of the certainties, variations in the net cash flow take place. These variations could be favorable as well as unfavorable. The possible unfavorable impact is the risk of the business. However, it should be understood that the unfavorable impact of uncertainties or the risk in a business is not constant or on a fixed magnitude. It can vary depending on the degrees of the severity of the adverse variations of uncertain factors. So, to clarify the point, let's discuss what are the things that can be gained by managing the risk. That is, preserving the capital. Effective risk management helps protect your capital by identifying and mitigating potential risks. You reduce the likelihood of significant losses. You have a stability and consistency. By managing risk, you lead to more stable and consistent returns over the time. It helps smooth out the ups and downs that come with the volatile markets. You can also meet your financial goals, as different individuals or organizations have different financial goals. Managing risk ensures that you stay on the track towards achieving these goals, whether they involve saving for retirement, funding a project, or any other objective. On the case of the compliance and regulations, many industries and sectors have regulatory requirements for risk management. This involves financial institutions, healthcare, and various other fields. Adhering to these regulations is crucial for legal and ethical reasons. You can enhance your decision making by understanding and managing risks, which allows for better informed decisions to be made. It enables us to assess the potential rewards against the potential downsides before making investments or operational choices. Adapting to the changing circumstances, markets, economies, and personal circumstances change over time. Effective risk management allows for adaptability in the face of these changes and can also protect against the unforeseen events. There are always uncertainties in life, such as natural disasters, economic downturns, or unexpected health issues. Managing risk can help prepare for and mitigate the impact of these unforeseen events. So, the criticality of risk management in the management process of an organization becomes apparent when viewed from the angle of a very survival of the organization, particularly in the severely adverse business situations. The loss potential of the business is strongly correlated to the uncertainties of the business factor, as it is the outcome of their adverse impact. So, with this, we sum up the first session, that is, what is risk. In the next video, we will be discussing about the risk management framework, in which we will be discussing about the organization of the risk management, the risk identification, the risk measurement, risk pricing, risk monitoring and control, and risk mitigation in detail. So that's it for the today's video about risk and uncertainties. If you have any question or comments, please feel free to leave them in the comment section below. Your feedback is invaluable to us. This is Nishant signing off from your channel, Brilliant Bankers. Please do like, subscribe, and share our channel to your friends and other bankers. Jai Hind.